Let's take a look at how you value a bond. So, bond's a legal arrangement between a borrower and a lender. And the borrower could be the U.S. government, they issue treasury bonds. It could be a corporation like Ford issuing bonds to borrow money to build a factory. Or it could be, a municipal government issuing bonds to build a school. So there's some terminology we need. There's the par value, sometimes referred to as the face value or the maturity value. That's the amount that's returned when the bond matures. There's a coupon rate, which is a percentage of the par value that the bondholder receives in interest each year. And there's a coupon payment, which is the interest payment they receive each year. And you calculate the coupon payment by taking the coupon rate and multiplying it by the par value. So the reason they refer to these as coupons is there used to be coupons. This is actually a scan of a bond I happened to find when we were cleaning out my uncle's house. And what you would do, apparently they didn't cash these in, you would clip off each one of these separate coupons and take them to the bank and receive your interest. Okay, today you don't really do that. If you bought a treasury bond, they would just have your bank information, and when the interest payment was being paid, they just direct deposit it into your account. But coupons used to be very popular. You're familiar these days with digital coupons you have on your phone, but there used to be physical coupons. There still are, not quite as prevalent. You get them at places like CVS, which will print you this really long receipt, and you can tear them off and get some money off of some product that you happen to buy. But people would buy the Sunday newspaper just to get coupons, and there would be pages of these coupons, and you would clip them out, and it might be $1 off for a box of cereal or 50 cents off for a jar of mayonnaise, and you would take it to the store, and when you bought those products, they would reduce the price by the value of the coupon. And these are manufacturer's coupons, so the manufacturer is giving you the discount. So what the store does is they gather up all the coupons and they mail them off. They don't send them directly to the manufacturer. Remember, you have a lot of different manufacturers. They send them to some company that sort of sorts them out and processes them. And the store would get back the face value of the coupon, say the $1 for the box of cereal, plus some fee for processing, maybe another 7 cents or 10 cents. And the same thing is true for the bank. So the bank would, take the treasury coupon that says $100, send it to the treasury, and the treasury would credit them that amount of money. The other things we need to know is there's a maturity date. When does the bond mature? And then there's a yield to maturity, which is the required market interest rate on the bond. So I've mentioned the coupon rate. That's the percentage of the par value you get each year at interest or but there's also a yield to maturity. There's a market rate. Interest rates go up and they go down. And if they change, the value of the bond is going to change. And that's why we have to, learn how to value a bond. What's the principle of valuing securities? The value of securities is the present value of the expected future cash flows. Bonds are straightforward to value because we know what those cash flows are. You get the interest payments or the coupons, and you get the return of principal. So let's take a look at a couple of different types of bonds. There's the zero coupon bond. This is the bond that does not make annual or semi-annual interest payments. So bondholders pay a price below the par value, and the difference is the interest the bondholder receives. So you might pay $900 for a bond that has a par value of $1,000, and that $100 difference is going to be your interest. You have zero coupon treasury bonds, and those are referred to as STRIPS. That's the acronym. It stands for Separate Trading of Registered Interest and Principal Securities. So these are not issued this way by the U.S. Treasury. They don't issue zero coupons. What they do is they issue coupon bonds, and securities dealers separate out the interest and the principal and sell them as separate securities. Some investors may want a steady cash flow of money coming in, so they would be interested in the interest, the security that just pays the interest. Others might have a longer horizon and would just like to receive the principal when the bond matures. So suppose you have a bond that matures in 20 years and has a par value of 1,000. What's the price of the bond if the yield to maturity is 7%? It's just the present value. In this case, 1,000 divided by 1.07 to the 20th power, which means that the bond's price is $258.42. So that $741.58 difference is the interest the person is actually receiving, right? They're only paying $258.42, but they're getting 1,000 when it matures. Coupon bonds make these regular interest payments, which we said were called coupons. And they make them either annually or probably more commonly semi-annually, which is twice a year. And so what do? You find the present value of these payments. And it has two parts. There's an annuity, which is the present value of the coupons, C being the annual coupon, and MV being the maturity value or par value. So you take the present value of the annuity and then add it to the present value of the lump sum. And if you use formulas, there's a formula for the present value of an annuity. It's C times this right here, plus the present value of the maturity value or the par value right here. So let's take a look at an example. XYZ is bonds that have a coupon rate of 6%, a par value of 1,000, and mature in 10 years. Assume that the yield is 7.5% and the bond pays annual coupons. So what's the annual coupon going to be? 6% times the par value of 1,000 or $60 a year. And if you plug into that formula I had before, present value of this annuity plus the present value of the maturity value, you get $897.04. So the bond is selling at a discount to its par value. Does this make sense? Well, yes. Interest rates have gone up. So newly issued bonds are now paying $75 a year in interest. That is 7.5% times 1,000, right? Bonds of similar risk and similar maturity. So if you think about it, who's going to pay $1,000 for a bond that pays $60 a year when they can buy a bond that's essentially the same that's paying $75 a year? So what's going to happen? The price is going to have to fall. And it's going to have to fall enough to compensate investors so that they also receive a 7.5% return. If you want to do this on a financial calculator, the number of periods is 10, N is 10, PMT is the annuity, 60. We put in the interest rate, I/Y stands for interest rate per year on the Texas Instruments calculator, which is 7.5, 7.5. You put it in as a whole number, not as a fraction. FV is the par value or maturity value, and then you hit compute PV. So let's see if we can do that. I actually had already done this. Let me just clear this, and I'll punch it in for you. So N is 10. The interest rate we said was 7.5. The payment was 60. And the par value is 1,000. And hit FV, and we hit compute PV. Find the present value, and that's the price. What if the bond makes semi-annual payments? that means they're making payments twice a year, so we have to do some adjustments. You're going to get two coupons a year, but only half the amount. So we have to divide the coupon by 2. We have to double the number of years because there are 2 6-month periods in every year. And we have to divide the yield by 2 because we're not looking at a semi-annual interest rate. We're not looking at an annual interest rate. We're looking at a semi-annual rate. So let's see what we have here, right? We have this bond, 6% par value, right? We did this before. We had $60 in coupons. That's $30 a year. There are 26-month periods, and the interest rate is 3.75%. That is 7.5% divided by 2. And if you punch into this, you get $895.78. So it's close to the other price, but it's not exactly the same. So when you're doing the calculation, you have to make sure that you do it based on whatever the however the problem, okay, or the stipulation in the contract says, right? If it's semi-annual or annual. And if you wanted to put it into the financial calculator, you would put it in this way, right? N equals 20, PMT equals 30, I/Y is 3.75, 1,000 is the future value, and then hit compute PV. All right, now I won't do that for you. Okay, we can also do this in Excel. Excel has slightly different notation. It doesn't use N for the number of periods, it uses NPER. It doesn't say I/Y, it says rate. PMT is the same, FV is the same, and the way you put it in is you type in equals, and you don't have to remember this because in Excel it tells you what to put in next. So let me go to my Excel spreadsheet here, and here I have the information put in already, and I'm going to say equals PV, and you can't see it very well, but it tells me I want the rate. So I'm going to hit rate, and then you have to hit a comma. And let me just note that in this case, in Excel, you can't put 3.75. You either have to put 3.75 with the percent sign or 0.0375. If you put in 3.75, it's going to think it's 375%. Number of periods is right here. And again, we could just type these numbers right in if we wanted to. I happen to already put these in. This is the PMT, and this is the future value, okay, or par value. And it asks you for type down here as well. That has to do with the annuity. Are you getting beginning of the year cash flows or end of the period cash flows for the annuity? In our case, we assume end of the period cash flows. It's what we call an ordinary annuity, so you can just leave it blank. If the cash flows, if the annuity, that 30, were at the beginning of the period, we would put a 1 in. Okay, but for the bond valuation, we don't need to do that. Close the parenthesis, and I hit it, and I get the same value. And just like the financial calculator, it gives you the opposite sign. So these are positive, the future value, and the PMT, or the annuity, is positive, so that the price is negative. And the calculator does the same thing. It does the opposite sign. But, so it's not particularly hard to value a bond, and you can do it in Excel, you can do it with the financial calculator, or you can use the formula. So I hope you found this useful, and thanks for watching.